Welcome to everyone to our fourth in our team of expert seminars. We would have historically been dealing with these in a slightly more salubrious location than we are now, whether in your study, bedroom, dining room, or maybe even outside. Today's topic is corporate finance update. It's split into two halves. So we're going to review the government-backed finance initiatives and then move on to what we're seeing in the world of corporate finance, which is quite different to what we have seen in the recent past, clearly. So on the call is myself, David Scrivener. I'm a partner at Ensors, for those of you who don't know me, and my colleague Simon Martin, who's a director in our team. Simon's going to be looking after our Q&A on the webinar this afternoon. So please familiarise yourself with how the Q&A works. If you hover at the bottom of the screen, I think that's how it works. You can type questions in there. Simon's then going to pick those up, and he might interrupt me if he feels like it, or otherwise we'll take them at the end. I think you can use the chat function as well, but the Q&A is just a bit neater. So moving on to the content for today, and hopefully the slides will work. That's me. I don't need to dwell on that. The agenda, so a summary of those main government-backed financing options, probably more importantly, a review of the scheme take-up and providing some insight. So what are we seeing as advisors from our clients on the receiving end of those schemes at the moment? I'll then move on to the second half, which is looking at current M&A and deal activity in the region. And then I thought what might be useful is a look into the future. So I've made 5 predictions to what I think we might see in the short to medium term in terms of deal activity in the region. So firstly, onto the government-backed lending schemes. So I won't dwell on this. When we set the agenda 5 or 6 weeks ago, these were quite embryonic and, to be fair, not working particularly well. I think since then they've got their act in order and are much better than they were. So I'm going to talk briefly about each scheme, but then just give you some stats and some more insight, because I thought that would be more useful. So there are 3 schemes primarily. There's the bounce back loans, which are the smallest businesses, only been going for a few weeks. Loans between 2,000 and up to 50,000 or 25% of turnover. There's the coronavirus business interruption loan, which has been abbreviated to CIBIL. So they are for businesses up to £45 million worth of turnover and £5 million worth of debt. And then there's the large scheme for businesses over 45 million. And in those cases, you've got up to £25 million worth of debt. So looking at each one, again, just briefly, I've only got a slide on each. The bounce back loan is backed by 100% full bank guarantee, full government guarantee, sorry, fixed interest rate, first 12 months interest paid by the government directly to the lender, no capital repayments for 12 months, 6-year term, but effectively a 5-year term once the repayment kicks in 12 months' time. And most importantly, no personal guarantees. So this is a very attractive debt for the smallest of businesses and has been very popular, as you'll see shortly. CIBILs, so for the sort of small to medium-sized businesses, this is backed by a partial guarantee by the government up to 80%, and the lender here determines the interest rate. Similarly to the bounce back loans, you've got 12 months of interest paid by the government and no capital again for 12 months, maximum 6-year term. This time personal guarantees can apply. They shouldn't apply at all if the debt is under £250,000, and they're capped at 20% of the outstanding balance for those above that, and that excludes taking a charge on personal property. So still an attractive piece of debt, particularly in these difficult times where capital is hard to come by. So that's the CIBIL scheme in a nutshell, and there's been some significant changes to that. CIBILs, when it first came out, potentially would have been a situation where the personal guarantee would have been called upon, and it could have been up to 100% of the outstanding balance, could have been called upon before the government guarantee. So a significant change there, and that has made it much more attractive. In terms of approved facilities, the bounce back loan has been incredibly popular, given that these are actually small loans going out. The the volume is huge. And actually, collectively now we've got over £8 billion gone out on bounce-back loans. These were figures correct as of about a week ago. I think they've gone up more than that since then. 6 billion on the CBIL, on the Corona Business Interruption loans, and just under 360 million on the larger loan scheme. So the bounce back loan from a standing start has actually absolutely rocketed ahead. In terms of the application success rate, the bounce back loan has a very high success rate on applications, just under 74%. I suspect that those that didn't qualify probably shouldn't have even been on the website and applying online in the first place. They probably weren't even actually satisfying the criteria, which is probably why they were refused rather than any other reason. It's a very slick application process online, and those have been incredibly popular. You see 268,000 as of last week, and a 74% success rate. The Corona Business Interruption Scheme, 36,000, just under approved facilities, and only a 50% success rate. So actually a bit lower than I would have expected. And then for the larger businesses, 59 successful applications out of 358, not a particularly good success rate of just over 16%. Average value of the facilities, the bounce back loan, you would expect this one, it's sort of mid-range between sort of the maximum and the minimum, 31,000. The CBIL loan, I think, is a bit lower than I would have expected, at £170,000 on average per borrower. And then the larger loan scheme, an average of 6 million, but quite a small population there. So to wrap up on the government-backed lending before we move on to the more sort of corporate finance transactional part of this webinar, our insights really across our customers that are applying for these measures. This is a different recession. I know we're not technically in recession yet, but clearly we are in a recession, despite what the statistics would say at the moment. In 2008, when the credit crunch hit, access to credit was obviously far harder to come by than it is now. And these government-backed lending schemes have really given people an opportunity, alongside things like furlough, to, they've bought businesses a significant amount of time, and things like the deferral of VAT, etc., etc. The initial offering bit, which was mainly the CBIL debt, the one in the middle, was pretty unattractive. There was too much information. There was too much information required. The viability criteria were pretty tough. And importantly, as I've already mentioned, the personal guarantees were pretty penal. So they've gone from a position of being very unattractive, probably now to a position actually where they are very attractive. If we've seen volumes go up considerably. And I would only speculate, perhaps too much so. It's a bit of an odd thing to say, perhaps, but part of me wonders if the relaxation on the personal guarantees, certainly to the level that we've seen on some debt, actually has put the balance too far in the favour of the borrower. And I don't think that's a problem now. I think it's a good thing for businesses now. But when capital and interest needs to be paid in 12 months' time, how much skin in the game have businesses got? That might lead to a cliff edge. And I will talk about that a bit later on. We're seeing, unsurprisingly, some differentiation in approach between lenders, and even within lenders. You're always going to get that. It's still based on somebody's application and somebody's interpretation of that application. So we are seeing some differentiation, particularly around the application of personal guarantees and other security. We're seeing the main banks, I know there's a number of them on the call today, generally looking after their own customers first, which is completely understandable, and not generally looking at other customers for these government-backed loans. But look at the application success rate. On CBIL, you've only got a 50% success rate. So there is a secondary market there for funders, typically the asset-based lenders, etc., who are approved to allow these or to provide these government-backed lending schemes. So they're worth considering if main banks aren't able to process the applications. And I think it's probably just worth saying that these schemes don't work for every businesses. Unfortunately, there will be failures now and in the future. And that starts to lead on to what I'm going to say about the future. So looking at deal activity now and some predictions. So unsurprisingly, this graph shows a significant drop in the volume of transactions that we've seen. March to April, a significant drop there. It was around about 300 to 350 a month of transactions, dropped right down to under 150 in April 2020. On the face of it, mainly, I suspect, COVID related. Our own experience, and I think experience of others in the region, was that we saw deals at least pause, some deals go off the table completely. So there may still be some deals that were being talked about in March or February that are still there ready to go. But there were other factors, we think, as well at play. One of which was entrepreneurs' relief. Now, this is sort of almost long since forgotten, really, but there were significant rumours pre-budget that entrepreneurs' relief was changing, and some believed, quite credible people believed, that it would be scrapped completely. So what happened there is we saw an artificial rush of transactions pushed through before the budget. The budget was March time. So we saw, actually, if you look at the stats there broken down by month, we actually saw an increase between March 2019 and March 2020, which, given that COVID was very much on the agenda, it was probably a matter of when we were going into lockdown rather than if we were going into lockdown. There was still a higher volume of deals done in March than ordinarily you would expect. April, however, fell off a cliff. Obviously, once April came around, we were in lockdown. So I think some of it was exaggerated by the fact that we had entrepreneurs' relief in the background there as well. So as I say, I've almost forgotten that we've had a budget, but we did just before lockdown. I think pretty much every budget since entrepreneurs' relief has been in play. There have been significant rumours that the relief was going to be scrapped. This time they were much stronger than usual. But Rishi didn't scrap it completely. So this is a tax that ultimately, when you sell your business or you sell your shares in a business, the likelihood is you'll pay a 10% rate of tax. What he actually did was cut the lifetime limit down from £10 million per individual down to £1 million per individual. So a significant cut, effectively put it where it was, I think, when it first came out many years ago. So what that's done is entrepreneurs' relief in most transactions in the region, particularly where you had multiple shareholders. So say you had 4 or 5 shareholders, if the lifetime limit was £10 million, that meant you could be talking about a transaction of 40 or 50 million pounds. There weren't many transactions actually where entrepreneurs' relief was an issue. Now, having taken it down to £1 million, if you've got the same 4 or 5 shareholders, that's going to bring a lot more transactions into the reckoning when it comes to entrepreneurs' relief planning. The current deals we've got on the go at the moment, this isn't as bad as I expected it to be. We've actually got 10 live transactions. Some of them are kind of just barely live, but they're sort of going along, or they're in a draw perhaps to be pulled out a bit later. But to just give you a flavour of some of the things that we're working on. So we've got a big administration case that we're working on at the moment of a boat builder that we're conducting a distressed M&A sale of at the moment. We've got an agricultural machinery business that we're selling. We've got a client of ours buying a lab. We've got a client buying a house builder, property developer, and we've got a sale in the manufacturing sector. And we're still getting new transactions come in. I wouldn't kid anybody and say that the pipeline is as positive as it was pre-COVID, clearly not, but it's not as bad as it was as I was probably expecting. I was there in 2008 in the previous recession, where after a while the phone stopped ringing, and it was pretty bleak. And at the moment, we may be just too early on to say, but it doesn't feel quite as bleak as it did then. So let's peek into the future. It is an uncertain world. Deals will inevitably continue to decrease in volume. But the previous recession that I referred to just now does give us some clues about the things that we should look out for, and the way that we, advising our clients, all of us on this call, should think about. It's not just a question of the fact that there'll be fewer deals, it's just that they might just be different, and you have to be a bit creative. So the 5 predictions that I'll come up with, I will come on to in a second. I've got one further slide. I think it's probably just worth adding a bit of context in terms of what was happening to deal volumes anyway. So over the last, or since the last recession, you can see in 2008, there was a peak of about 1,300 deal completions, which dropped like a stone to circa 700. And it bumped along there for a while until we started to come out of recession. And you'll see there was quite a steep growth curve from about 2014 to about 2016. And then something called Brexit came on the agenda. And that definitely checked, or at least checked and slowed down the deal volumes. That crudely drawn red arrow on there shows that if we'd have continued on the trajectory before, we probably would have hit 2008 levels by about 2018, but we didn't. You can see that that's already taken a number of deals off the table through the uncertainty of Brexit. So you can view that in two ways. You can say either we are starting from a lower point, so we might not have so far to fall, or perhaps that depth of 700 deals per quarter might be exceeded this time round. So our predictions, employee ownership. This was a growing theme pre-COVID anyway, partly driven by tax. So the notion of employee ownership is not new. The legislation, the tax legislation around employee ownership is not new either. But shareholders can sell to an employee-owned trust, an EOT, free of capital gain tax, completely free of capital gains tax, so long as it qualifies. And there are some quite difficult and tight rules. And historically, when Entrepreneurs Relief was at 10% pretty much for most of the deals that we would do, we would generally see most business owners favour a management buyout because of its flexibility over an EOT. But we are already seeing these as more favourable pre-COVID. I think, given where we are with Entrepreneurs Relief now, particularly for deals where business owners, shareholders are going to be suffering tax at more than 10%, EOTs will be looked at much more carefully. And the important thing about EOTs is they're controllable. You're selling to people that you know, and rather than selling to the trade, which is going to be particularly difficult in this economic climate, particularly in the short term, you've got some control over the process. So that's the first prediction. The second prediction is MBOs, management buyouts. We do a lot of these each year anyway. And again, controllable. So you're selling to people that you know. You're not trying to put it out on the market and all of the signals that might suggest, particularly at the moment. So I think MBOs will at least continue and probably increase in popularity. And the point is, an MBO and an EOT to an extent is a bit of a de-risking opportunity for a shareholder. So for most business owners that we work with, their most significant asset is their privately owned business. Generally, most of their wealth is locked up in it. And I think one of the things that any economic contraction does, it makes people think about their own risk. And if you've got companies that have got properties in them, they've got significant cash in them, then we're finding that shareholders are approaching us and will continue to approach us to look to de-risk. There's a number of ways you can do it, but one of the ways is to look to sell to management as part of a transaction for the succession of the business. It's quite a small point and quite a techie point, but I think we will see loan notes used in a different way to what we've seen historically. Now that Entrepreneurs Relief has become tighter, I think we'll see more people looking to defer the tax, whereas historically we found on MBOs and on trade sales that the preference really was to maximise the amount of consideration that was taxable at completion, because it would all qualify for Entrepreneurs Relief. I think we might see a little bit more caution now, and actually a structure where we can defer the tax in certain circumstances, because actually Entrepreneurs Relief won't be available on the full consideration. Third prediction, private equity. So private equity is still open for business. So private equity has always played a predominant role in transactions, with about 20% nationally and just over a third of London transactions. I think regionally we see fewer private equity transactions within this side of East Anglia in particular. But what we saw in the last recession in particular was actually a number of private equities looked to the regions for higher quality, low risk deals. You tend to find that actually when there's a significant volume of transactions, those deals find the PEs, but where the volume of quality deals reduces, the PEs have to go and look for them. So you tend to find that the regional deals will become more popular. So as private equity continues, we think, to deploy capital on transactions at least a constant level, and if deal volumes generally are falling, so if trade deals are falling, we expect that private equity will be a more predominant proportion of deals going forwards. In 2019, private equity firms had a record level of cash on their balance sheets, and therefore they're well placed to transact, although you have to remember there may be capital within their portfolio that they need to deploy to prop up existing investments which may be struggling. Particularly if that private equity fund has got a significant bias in something like restaurants, then clearly there may be needs closer to home that they may be looking after first before they're making other investments. And also, will private equity be able to take advantage of lower multiples or lower pricing? And that's the fifth thing that I'll talk about later on, so I won't dwell on that now. So the fourth one, you won't be surprised to know, we think that distressed deals will increase. So either a business being sold prior to insolvency, at the time of insolvency, a pre-pack, or after insolvency, so sold via an administration process. And again, with some crudely drawn arrows on there, it shows that corporate insolvencies, certainly over the last year or so, and even over the last sort of 5 or so years, have been fairly constant, at a fairly low level, actually, surprisingly. But there's going to be an uptick. Undoubtedly, there will be an uptick. And what that will spawn is more distressed transactions. Not every liquidation or administration will create a transaction, but many will. So we expected, when Mark Upton and I sat down with 2 insolvency practitioners, we expected actually the impact from an insolvency, a formal insolvency and a distress point of view would be delayed. There is a significant amount of deferral available out there. We've talked about that earlier. There's the furlough scheme, there's the loan schemes, but nonetheless, there are some businesses that are failing already. Largely, they are businesses that were in desperate trouble pre-COVID, and COVID has been the final straw. When looking at distressed deals, we were asked this question last week on Simon's webinar. How do you value a distressed deal? Well, I think valuation theory really goes out of the window. We're not talking there about a multiple of profits generally, because it may not even have made a profit. There you're looking at valuing the assets, understanding what liabilities you're taking on, particularly things like TUPE liabilities for employees. That's one of the significant hidden liabilities that you might be taking on. The other thing we encounter quite often on distressed deals is people that just don't quite get it. So you need to move very quickly. The number of times we try to do distressed deals and then people are trying to conduct very thorough due diligence, there isn't time for that. It has to be reflected in the price, and it's very much a question of buyer being beware. I think a few cliff edges are going to cause businesses problems going forwards, and I think those are the times where we might see spikes in distressed deals. So whenever furlough changes or ends, so we know Rishi stood up last week and thankfully I think for most businesses extended furlough to the end of October. There's still some uncertainty about quite how it will look from August to October, and clearly that might be an issue for some businesses. There is an issue for businesses that need to come back on a partial basis. Actually, they may make greater losses in partial operation than they would do in a total sort of mothball. So that's going to be a challenging time for a lot of businesses. At some point, there will be an end of the deferment culture. Landlords, rates authorities, lenders, HMRC, there is going to be an end to that at some point. Reflecting on the last recession, really HMRC took some time before they actually got to a position where they got tough. it sort of went in waves. There became a period where they would get tough for a while and then they'd row back. And I suspect we might see that again. We'll probably see a situation where time to pay arrangements certainly will be tougher to come by than they are at the moment. And then the third cliff edge is on the civil loans or the other government-backed debts. When those capital and interest repayments start to happen in 12 months' time, that's going to be a crucial point for businesses. You're looking at debt that's got to be repaid within 5 years. If the business hasn't quite recovered by that stage, it could lead to some distressed sales happening at that point. It could obviously lead to lots of other things as well. It might need a refinance. But as I say, that's a potential cliff edge that we see coming on a longer term horizon. So fifth and finally, in the predictions, well, unsurprisingly, I think it's going to be harder to get debt for transactions. I'll be interested if any of the bankers have got any observations on that. The short-term impact clearly on lenders at the moment has been looking after their existing businesses rather than looking out for new business opportunities. That will change, I suspect, over time. But at the moment, that's probably true. We'll obviously see for those businesses that have already borrowed more debt on the balance sheet. So the ability to leverage those balance sheets to get more debt out to fund transactions will not be there. And ultimately, we think we will see lower deal values. I think probably in the last recession, what I was asked most commonly was, well, how much is my business worth now? And probably the most accurate statement I could say back was, well, it's worth less than it was before the recession. And you just have to be sensible about these things. I have got a slide with some stats on that shows the multiples and how they reduced in the last recession, and I'll come on to that as the last slide. Simon last week talked from a more theoretical point of view in terms of some of the valuations we do about the triple impact on valuation of COVID. But it's really important for corporate finance deals as well. So we will see reduced earnings in some businesses, in a lot of businesses because of COVID. And it will be a judgment as to how much you can attribute to COVID and how much is just a general downturn. There will be reduced multiples in most industries. And for those businesses having to take on increased debt, government-backed or otherwise, that will also negatively affect valuations. So, beware that triple impact on valuation when it comes to looking at deals that might come to the market going forwards. So say this is a slide that illustrates what happened last time around in 2008. Actually, there was a lag before the multiples started to fall. So before the values of businesses started to fall, it wasn't until we were kind of just about out of the technical recession, but that the multiples started to really decline. And that's partly because sometimes there's a lag. Deals are in the pipeline already pre-recession and they still get completed. Once you're mid-recession, that's when the more distressed deals will be happening, and that would obviously have an impact on multiples there on an average basis. So we expect it to have an impact, clearly, and that's not good if you're a seller, but potentially that's good if you are a buyer of a business. So to wrap up then quickly, just before we hand over to questions, government-backed debt, alongside the other measures like furlough and things that we've mentioned, have propped up UK business. Without it, they would have been looking at mass failures, business failures. It's bought time, but how much? I've mentioned those cliff edges. So it's certainly been a positive impact for UK businesses, but there are tough times still to come. UK deals will inevitably fall in volume and value, and watch out for that triple impact on valuation that I mentioned earlier. There will, however, be opportunities. There were opportunities in the last recession, and there will be opportunities again. So those good, well-managed businesses will get through this. I think we can say that with more confidence now than certainly we could 10 weeks ago. And then they'll be well placed to thrive thereafter, either because they're operating in a market that's got fewer competitors, or they're able to go out there and they're able to take advantage of some of the distressed opportunities and grow their business. That might be a few months down the road, but we think that will be an opportunity for for some of our clients and some of your clients to take some positive from this. At which point I've rattled through that, hopefully roughly to time. Simon, have we had any?
Yeah, there's a couple of good questions. The first one is, do you think that there will be merger mania with good corporates who were affected getting together to poor resources?
That is a good question. Potentially. I don't. If the answer is sticking all of those businesses together, I see that as probably unlikely. I think there will be activity. I've just referenced that there will be activity. I don't think it will necessarily be all of the distressed businesses coming together. I think ordinarily what you would see is the stronger businesses hoovering up the weaker ones.
Brilliant. The next one's on EOTs. So if EOTs gain popularity, how do you think this could affect the secondary buyout market after these transactions, given there'll be a more complex ownership structure?
Yeah, I mean, that is one of the biggest drawbacks about EOTs is, what happens next. They are meant to be an employee-owned mechanism almost permanently. And the ability to sell going forwards is something that exercises lots of minds. I think it will, therefore, if we get a huge increase in volume, I don't think we'll see, thousands and thousands of EOTs, but we will see more of them, I think. And therefore, I think that will have an impact negatively on the secondary market going forwards.
Okay, and then the final one, in previous periods of business downturn, have you noticed a shift in the characteristics of businesses which people are interested in? For example, asset-backed businesses more favoured?
Okay, so yes, definitely. You'd see an asset-backed business as more favourable generally anyway. Anything that involves a significant amount of goodwill is clearly going to be more risky as an acquisition than those that don't have a significant amount of goodwill and have got some assets to fall back on. So yeah, traditionally it would be the businesses that have got a lot of capex, a lot of asset value that would be most attractive, particularly because in a distress scenario, not only are you likely to be paying virtually nothing for goodwill, or if you do, it will be a token gesture. You're also going to be paying a depressed asset value as well. So if you know what you're buying and you know the industry you're buying in, you would almost certainly favour an asset-based business over one that's got few assets.
Okay, great. I think that was all of the questions I noted down.
Okay. That's good. If there are no other questions, the webinar is being recorded, I think, which is a bit scary. It will be available on the ENTSOR's YouTube channel, along with the other seminars and webinars that we've been doing of late. So anyone who wants to have a second look can go there. We will send some feedback out after the webinar, or some feedback requests out after the webinar, so please complete those. It's really helpful. I hope it's been useful. Certainly looking into the future, we hope some of those predictions do come true. We hope some of them are hopefully slightly too pessimistic, but it is going to be tough. But there will be a way for all of us as advisors and looking after our clients to see our way through this. So thank you all for listening. Thank you very much for those of you that raised questions. Thanks to Simon for hosting those. And if you want to sign up for next week's webinar, which is on private client tax, we've already got a number of people signed up, but there is still some space on that. So have a look on our website and sign up to that if you want to. But otherwise, it's left for me to say goodbye and thank you very much for listening.